Bank of America and JP Morgan say U.S. economy is doing well, consumers are in good shape despite inflation. Bank of America CEO Brian Moynihan and JP Morgan and Chase CEO Jamie Dimon both agree that the U.S. economy is doing well and consumers are in good shape. The consumers basically have more money in their accounts by multiples than they did pre-pandemic, said the Bank of America chief. Bank of America CEO Brian Moynihan said at the Institute of International Finance (IIF) annual membership meeting in Washington, D.C., last week that the U.S. economy is in good shape despite inflation, jittery markets, and international tensions, Bloomberg reported. He revealed that the bank's customers continue to spend freely. Their transaction volumes increased 10%.
Run out of those balance sheets.
David, good to be with you again. So let's step back and talk about the different ways we talk about resiliency. First is, are the consumers spending? Are they doing things that drives the U.S. economy, as you well know? And so the spending for the third quarter was 10% higher than it was last year's third quarter. The spending for the first couple weeks in October is 10% higher than it was last October for the first 2 weeks. Now, what we told people was you're seeing it slow just a hair. So it was maybe 14, 15% early in the year, 12, and now 10, which is frankly what people are trying to do is get the spending down a little bit, get the inflationary pressures down and the drag of the interest rates, but it's still strong. And then so that's one way to think about it. Another way to think about the consumers, do they have money in their accounts to spend? And in the month of September, the account balances were flat or slightly over where they were in August. And that is multiples of where they were pre-pandemic, and they continue to hold their own. And you can see inside the cash flow in customers, not making any reflection on this is tough on certain customers, others, but even when customers have lower income levels, we can see them cash flowing positive still. Rent increases could slow that down, other things could happen, but the core thing is, as of the third quarter, they continue to cash flow and they continue to have more money in their accounts than they did before the pandemic by multiples. And then you go to their credit quality, and the credit quality of Bank of America in our consumer books is very strong across the board. The payment delinquencies are much lower than they were pre-pandemic, much lower than they were in any average 5 best year type period. And yes, they moved a little bit off the floor, but they're still much lower than they've been. So consumers are spending, they have money, they're employed, you can see the unemployment numbers, and they have good credit. And that's good news for America, but it also makes the Fed's jobs tougher because they're trying to slow down this American consumer, which is a very resilient thing.
But just to make sure I understand it, and obviously you can't promise what's going to happen next year. I'm not asking you to do that. But a lot of economists are saying because the balance sheet were so strong coming out of the pandemic, at this point you don't see those balance sheets really turning down as we get into next year.
We don't see it yet. And so if you look back to 2 quarters ago when we did the earnings call, people are like, oh, the consumer is getting knocked out of the game, they're spending their accounts. 6 months later, the money's still there. So I think people are over-anticipating the future. We, as our projections, Canada Balance Plot, and the team in our research group, which is one of the best in the world, has the third quarter positive, the fourth quarter negative, the first quarter negative, the second quarter of 23 negative, and the third quarter of 23 negative, albeit at like a 1 to 1.5% GDP annualized growth rate, negative growth rate. So we are predicting a shallow economy. That's our core assumptions. And embedded in that, if you look at how we set our reserves, we have the assumption that we're going to have 5.5% unemployment. I'm not sure that's going to happen, especially this quarter. We have it at 5%, but that's the conservatives when we build our balance sheet from an operating basis. But if you look at the consumers, there's not the signs that we see in our numbers or other people's numbers, quite frankly. It says they're slowing down yet or they're in stress yet, and that will have to be part of what happens in order for there to be a deep recession, because if the consumers have money in this big consumer-driven economy, that's what keeps America strong.
Brian, you've always taken great pride in the Bank of America research unit and how good they are. Let's assume their numbers are exactly right. It could be better, could be worse, exactly right. 3 down quarters, 5.5% unemployment. What does that do for your loan loss provisions? What kind of provisions do you have to make for that?
Well, inherently, we're always discounting the future because the way the CECL rules work, so-called, you look out for the life of loans. So you build reserves, and we built $400 million or so this quarter, which is building that scenario, which is 60% to the base case, which is the average of blue chip economist, and 40% to an adverse case. And when you blend that together, it implies those adverse cases have high inflation and have high unemployment in them. And you blend it together, the core, what we did at the end of the third quarter, has 5% unemployment. The third quarter has 5% unemployment for the fourth quarter quarter of 22 and more than like 5.5 for next year. So it's very conservatively built. So your provisions will go up against that backdrop. At one point, you'll start to see the other side of it emerge, and that's what sort of happened back in the pandemic. We put up a lot of reserves, and we took them back in once you saw that the impact of, because what the administration did and what Congress did and what the central banks did around the world, you actually mitigated the effects of the unemployment numbers. That won't happen in a standard recession, I would expect. But on the other hand, the consumers are going in much stronger shape than they did even in 2006-07, leading into the great financial crisis.
Brian, throughout your tenure, as far as I can tell, you've really embraced what you call responsible growth. We know what it's looked like in the last few years. What does responsible growth look like for Bank of America in the next 4 quarters? Just take 4 quarters.
Well, we continue to look for deposits to basically outgrow the industry, and the industry is predicted to go down to flat, and we will be in that range because, frankly, the monetary accommodation will be drawn. We look at loans to grow in the mid-single digits. They grew a little faster year over year. Then we slowed down a little bit because of some of the capital changes that occurred in the third quarter, which we've taken care of and put in the rearview mirror. So we sort of look at that. But the key about responsible growth is people forget it's not only the growth, it's also how we get there with our operational excellence platform, which allows us to drive expenses. The work we do in OPEX continues to fructify into further and further gains for us. So that we had 3 quarters in a row of flat expenses while the revenue kicked up, and that's where you see the margins kick in, and our efficiency ratio is down in low 60s and moving south from there. Those are good things, but that comes from hard work beyond just can we get growth. It's how we run this company, and the team's done a great job doing that.
So, Brian, again, you've prided yourself in really carefully blocking and tackling on the expense front, and you've gotten a lot of credit for that. What does that say about employment in the scenario that you're laying out? You could have cuts, but even apart from cuts, maybe through attrition, do you expect your payroll to